Hi, today we will test a scalping strategy based on the RSI, and as you can see, the backtest over 3 years of data is showing a profitable outcome reaching 250% of equity increase after 3 years of trading. This is roughly 50% per year. The strategy uses two indicators, the exponential moving average and the RSI, and the backtesting is carried out using our Python code. The code is available for download from the link in the description of the video. You will find 3 different versions, one related to 1 minute candles time frame, the second is for the 15 minutes candles, and the third file is for 1 hour candles time frame. I have tested this strategy on these different time frames and all is covered in this video, so stay tuned. The strategy rules are the following. First, we look to the current price, if it's trading below or above the 200 EMA. If it's above, we consider we are in an uptrend, like on the right side of this graph. And if the prices are trading below the 200 EMA, then we consider we have a downtrend. So if we are in an uptrend, we will only look for buying positions, and the opposite is true, meaning if the price is trading below the 200 EMA, so we have a downtrend, we will only look for selling positions. Then we can check the 2 candles RSI. I know it's very short, but this is how the strategy is built, and we will start with this. Now, I should mention here that this is a strategy that was described on the 1 minute time frame. However, this would generate a huge amount of data for our program. Since I would like to test this strategy over a period of few years, I'm going to start the testing with the 15 minutes time frame first, and so we might be changing the RSI length to optimize the results. So instead of 2 candles RSI, we might be using 3 candles or 4 candles RSI if we are changing the time frame. But anyway, for the 1 minute time frame, we are going to use 2 candles RSI at first and test the levels below 10 and above 90 for the RSI. So if we are in an uptrend and we are looking for a buying position according to the price level and EMA comparison, we will wait for the RSI value that is below 10. And when the current candle closes this way, we can execute this position. For selling trades, we will wait for an RSI value that is above 90, and therefore we will have our entry point for our selling position. So for example, here at this point, we have a price trading below the 200 EMA, and we have at this candle here, we have an RSI that is reaching a level above 90. So we put this point here just to mark our entry position. So this candle is going to be our entry position. It might be this candle too, because the RSI also is exceeding the level 90 here at this point. So since this candle is closing higher than this one, than the future candle, it might be a better entry position for our trade. Then on the right side of this graph, we have an uptrend because the price is trading above the 200 EMA. And at this point, at this particular candle, we have an RSI level that is below 10. So we have our entry position for our buying trade. And now we reach the tricky part where we have to decide how our stop loss and take profit values are set. So we can use a fixed distance stop loss or an ATR related stop loss distance, or even a trailing stop value, which can also be either fixed distance or ATR related as well. And the take profit will either be at a fixed distance from our position or related to the stop loss distance with a certain take profit stop loss ratio. So as you can see, it's a lot of management methods to try, but we can write all of this in Python, run our tests over a year or 3 and see how our trading account is affected. And one more thing I will do in this video, and I believe it's very important to check the robustness of this model, is that I will tune the model, let's say on 3 years data, but then to confirm the profitability results, I will test it on new data that I have kept on a side to avoid any bias. Okay, let's dive into the code and analyze our results. So this is our Jupyter Notebook file. We're starting by loading the data, and I'm going to start by the data between 2019 up to 2022. So this is roughly 3 years of data on the 15 minutes time frame. It's the bidding prices, and it's euro versus US dollar. Our data looks like this. We have a data frame with the indexes, the local time, the open, high, low, and closing price, and the volume for each row for each candle. Then we can clean the data from volumes equal to 0, which means these are weekends or days off, bank holidays, these are not of interest for our study because we had no market movements on these particular moments. We're going to reset the index and we're going to print the tail of our data frame just to make sure that we have enough data. This gives us an idea how many rows we have at the end of our data frame. And we are going to import the Pandas technical analysis module as TA. We're going to compute the exponential moving average 200 using the ta.ema function. On the closing price of the candle, the length is equal to 100. Then the RSI is calculated using the RSI function on the closing price of each candle, and the length is kept equal to 3 here because, as I have said previously, we are using the 15 minutes time frame instead of the 1 minute, and I had to adjust it a bit to take this change into account. Then we are going to use the ATR, the average true range, to calculate the distance of our stop loss in some cases, depending on which trading management strategy we are going to follow. So now our data frame contains more columns. We have the exponential moving average, the RSI, and the ATR on top of the previous columns that we already had as a start. We can start computing the exponential moving average signal. So this is the trend detection. Remember that if the price is trading above the EMA, the 200 EMA, we are considering we are in an uptrend. And if the prices, meaning the candles, are below the 200 EMA, we have a downtrend. This is our way to detect the trend in this particular strategy. Now, when we say the price is trading above or below the 200 EMA, which price are we talking about? How many candles are we talking about? Am I going to wait for one candle to cross the 200 EMA and I immediately can consider that the price is trading in an uptrend? Or should I wait for a confirmation, let's say 8 or 10 candles that are trading above the 200 EMA, and then I can say, okay, it's confirmed, we have an uptrend or we have a downtrend. Or even more, maybe you can wait for 20 or 25 candles. And this is kept in a parameter. This is variable called back candles. Here, for the moment, I'm using 8 candles. So 8 candles, 15 minutes each. This means that the price has been crossing the EMA or is trading below or above the 200 EMA for at least 2 hours. Of course, you can change this later on and experiment on it. I kept it as a variable on purpose. And this part of the code is going to check how many consecutive candles do we have above or below the 200 EMA. In this case, we are going to choose one of 3 values. If it's a signal equal to 1, it means we have a downtrend. If it's a signal equal to 2, it means we have an uptrend, meaning the candles are trading above the 200 EMA. And if it's equal to 3, it's something a bit tricky. It means we have an error because you can't trade above and below the 200 EMA at the same time, especially if you have 8 back candles that you are considering here. And all of these signals are now added to our data frame in a column called EMA signal. Remember, this is only the trend detection signal. It's not our final signal. So we still have to consider the RSI, and this is the next step. This is something I call the total signal. So at this stage, for each row, if the EMA signal is equal to 1, meaning we have a downtrend, and at the same time the RSI is above or equal to 90, it means that we have an entry point for a selling position, and therefore our total signal value will be equal to 1. And I'm going to store this in list called total signal that I have just defined here at the beginning of this cell. Then if I have an uptrend, meaning the EMA signal is equal to 2, and at the same time the RSI is below value 10, in this case we have an entry point for a buying position, and my total signal is going to be equal to 2. So at the end, I'm going to put the total signal in a new column in my data frame that I called TOT signal, just like that. And at this stage, we can perform one more cleaning for our data because remember, sometimes the RSI at the beginning or the moving average at the beginning of the data frame can't have accurate values. It might be non-numerical values, and in which case we can clean those from our data frame and reset our index. And now we can start our trading testing. But before trying the backtest of the strategy, I usually like to visualize things, visualize signals on charts, and check how my indicators or my custom indicators are behaving. So I'm going to add one more column into our data frame, which is called points position. And if the total signal is 1, it's a selling signal, I'm going to put a point above the high, slightly above the high of the current candle. In the opposite direction, if the total signal is a buying position, in this case, I'm going to put a point just below the low of the current candle, just to visualize things on a graph, on a chart. And now, depending on how many candles I would like to visualize, it can't be too cluttered because it wouldn't be very clear for us, and it can be too empty because it wouldn't show enough cases to study how the model is behaving, how my indicator is behaving. So first of all, I defined a new unit called months, which is 24 times 4 times 30, meaning 30 days times 24 hours times 4, because we have 4 candlesticks of 15 minutes each to form 1 hour. So this is a month unit. And then the starting index is simply of the row where I would like to start my plotting. So if I'm putting here 67,000, it means that the first candle on this graph here is going to be 67K, 67,000, depending on my data frame. Remember that the last element of our data frame is 74,000, so we should be careful also not to exceed the limits of our data frame. So I'm going to put this back for now to 0. For example, we're going to start at the beginning of the data frame, meaning at index 0, and I'm going to slice the DF plot for the data frame plotting a part of my data frame that is starting at the start ID, which is 0 now, and ending at the start ID plus the integer cast of something related to months. So it can be 0.4 months, 2 months, 3 months, 30 months. Okay, so this is one way to do things. It's not the only way. You can have different methods to use these functions, but the most important for now is that I'm going to plot the candles, I'm going to plot the 200 EMA, and I'm going to add a scatter where the buying and selling positions are. So this is the signal, the total signal that we have added into our data frame. And this is what we have. This is what we get. This is our result. We have the 200 EMA. We have these candles here trading above the curve. So we are in an uptrend theoretically. And at the same time, these points will indicate the positions or the candles where we had RSI values below 10. And these are our buying signals. So we can zoom in and see how things are behaving. So this one here is, for example, a downtrend. We have prices or candles below the curve of the 200 EMA. And at the same time, as soon as the RSI crossed the 90 value, the 90 mark, we have different signals of selling here, selling positions. So as you may have noticed, these are false signals because here, if we would have sold, we are crossing the 200 EMA towards an uptrend later on. So maybe we would have touched our stop loss before going down here and touching our take profit, depending on how you are managing your trade. Anyway, for the uptrend points, we have one signal right here, but then again, this one, the second signal, is a proper one. So we have a large uptrend, a large rise in the price without really going down much. So it's very unlikely that we would have touched our stop loss value for this particular trade. So this signal here is really good. Then we have this signal, which is also a good signal because we have a rise in the price later on. This one is also a good signal, and so on. This one here is not very clear at the moment, so we can try to zoom in. So this is a zoom in into this particular trade. We have a signal here, and if we would have bought at the closing part of this candle, meaning down here, we would have a chance to have a winning trade only if the take profit is close enough from our position. But then again, if we are taking take profit stop loss ratio that is equal to 2, for example, most probably we are going to touch our stop loss before touching a wide take profit value. As any strategy, it might work, it might not work. Sometimes it's giving good results, sometimes it might not. The best way to deal with this is to backtest it over a long period of time and check the end result of this. So at first I was backtesting this strategy over a month or 3 months or 6 months. But then I noticed that sometimes it's giving positive results, sometimes it's negative. And the best way to get what is the outcome of this particular strategy over a few years, or the averaged outcome per year, is to test it on the whole data set. So the data frame is around 75,000 candles after cleaning, which is roughly 30 months, more or less. So I'm going to start with the start ID equal to 0, and we're going to test our strategy over the whole data set, over the whole data frame, which is 30 months. I will not go through the details of these functions. We've been using the same cells for backtesting over and over in my previous videos. So I'll just jump to tell you that the initial size of the positions is going to be around 20%. So this is high risk, but in scalping, if you are putting roughly $100 cash, it's not much. I wanted to test if this strategy is able to make you rich quite fast without too much risk. So $100 with a margin that is 1 to 50, and we are trading 20% of our equity for each trade. I'm not activating the martingale approach that we have explained in previous videos, but if the signal is 2, so we have a buying signal and we don't have any open trades, remember that we are allowing only one open trade at a time. So we are going to execute a buying position here, a buying trade with a stop loss, a distance that is fixed to 45 pips, and a take profit distance also fixed to 45 pips. So this is our first test. Remember that we are testing these in different trade management approaches, and this is the first approach where we are using fixed distance, stop loss, and take profits for both the buying positions and the selling positions. And the back test over $100 account, so we have an income of 52%, like a return profit of 52%. You have a maximum drawdown of minus 62%, which is something to consider if you are trading with 20% of your equity. The winning rate is 52%. It's not that bad. It's not spectacular either. And most importantly, if we check the equity graph, we have a rise at some point. We have a peak at here, and then we have a losing year. It's probably almost 1/3 of our data. Let's say the last 6 months of our trades, the last half a year, is nothing but losses, more or less. So it's important here to know that it might not be coming from the signal. It might be coming from the way we are managing our trades. So remember, we took 45 pips, equal distance for stop loss and take profits, and over all the 3 years period. So now we can try something different. I'm going to try exactly the same thing. So over 30 months, dealing with 20% positions of our equity, but this time I'm going to use the ATR and the take profit stop loss ratio for the take profit distance. So stop loss and take profits now are related to 2 parameters. One is the ATR of the current price, and the second one for the take profit, it's regarding the take profit stop loss ratio. I put these 2 parameters to 1.3 at first. So our stop loss distance is located within 1.3 times the ATR, and the take profit is 1.3 times the stop loss distance. And I'm going to run this over the 3 years data, over the whole data frame. And these are our results. We have 116% in return. So this one looks more profitable. We have a winning rate of 49%, so it's not much improvement. Actually, it decreased from the previous case. And the maximum drawdown is minus 17%. So this is much better than the minus 60% that we got previously. And now we have the equity graph. Look at this. This one is really better, much better than the previous one. So using the ATR in this case gives something that is continuous winning strategy over these last 3 years. Remember, we are using data from 2019 up to 2022. And here we are reaching a maximum of around 220%. We can stretch this a bit by increasing the margin or increasing the take profit, or playing on the parameters of the take profit stop loss ratios and the ATR related stop loss distance. So I'm not going to go through this now because it's a real maze when you have 3 to 4 parameters and you want to modify each one of them. It would make our video too long. Just so you know, if you have the patience and some time, you might be able to squeeze up to 300% or 400% using this strategy here in 3 years. Now, another way to do this also is by using a trailing stop loss related to the ATR distance. So I'm going to use exactly the same thing we have already described. So 20% position of the equity and $100 in cash, let's say, and 1/50 as a margin. So 1/50 leverage account. I'm going to define the stop loss trail distance, which is equal to 1.5 times the ATR of the current price. And we're going to use a trailing stop loss. So this is a stop loss that's going to follow the price as long as it's going in the winning direction. But when the price curves back into the losing direction, this particular stop loss will not move anymore and it will be triggered, and we close with a certain profit if we had a previous movement, a previous winning movement before that. Again, this part of the code doesn't change much at this point, and when we are testing this, we get 67% in return over 3 years. It's not much, it's around 20% per year, but it's not bad either, we're not losing. This is the slope of the equity through the time of our trading. So we can see that it's a climbing equity, is a positive changing equity. We have large periods where we have drawdowns, and you have to be patient if the model is not working properly. Usually in algorithmic trading, you will not run one single strategy at a time. You would be running different accounts with at least 4 to 5 different strategies. And when one is failing, or when 2 are failing, you will be hoping that the other 3 are making up for these losses and they are still winning. So usually if you have positive equity algorithms that you are using for trading, you can always count that no matter what happens, the global outcome is going to be positive because you are running different algorithms at the same time. This is usually how it's done in big firms. This is usually how it's done with professional algorithmic traders. So anyway, it's not as bad strategy. However, it's not as spectacular as using ATR stop loss and take profit with a certain ratio, as we have seen previously. Now, I was curious if we would test exactly the same parameters, the same strategy, everything the same on 3 different years. And this is regarding the robustness of our model. Let's go back to the beginning and load into our data frame a different set of data. At first, we started with the 2019-2022. Now I'm going to comment this line and uncomment this line where the data loaded is between 2016 and 2019. Again, this is the same period of time. It's like 3 years of data, only it goes from 2016 and on. And we're going to run this, and I'm going to run all the cells exactly as they were run for the previous set of data, just to show you the differences if you change the time we are running the same strategy on. Okay, the first strategy, the first management strategy using 45 pips fixed distance for stop loss and take profit values revealed 93% in return for the 3 years. And let's check, the win rate is 52%. So it's almost like the previous case, like we had for the previous set of data. The maximum drawdown is -51. It was around -60 for the previous set of data. So nothing surprising here from this perspective. Let's check the equity curve. So the equity curve is showing a profit at a certain point, or starting from a certain point. When we are reaching something close to the data we already tested on 2019. So when we are in 2018, the second semester, let's say, it's starting to win. But before that, for almost 2 years and a half, we had nothing, no winning, no wins, no increase in the equity. Well, we had wins and losses, and so on. So as you can see here, we've been waiting for 2.5 years without seeing any results. So most probably this strategy works well for the recent data, but it doesn't work well for the previous data. Let's check the other trading management stop loss and take profit distances and see what it gives. So this is the second strategy where we have the ATR related with take profit and stop loss ratio for the stop loss and the take profit values. These are the results. We have 92% total return, and what I'm interested in is the winning rate, which is 47%, also like the previous set of data, so nothing really surprising here. The maximum drawdown minus 23%, something very close to the previous set. And this is the equity curve. Again, we can start seeing profitable equity starting the last third of our data. So it's like in 2018, this strategy starts working properly. Now for the third method, where we are using a trailing stop loss, we can use, let's say, 1.5 distance ATR as a stop loss distance, and we will check the results. It's 40% of return overall, and we can check the equity. Again, we have the third part of this data is showing positive equity returns, but then the first part, the first 2 years, are not showing any profits. So what we can say about this strategy is that running this on the 15 minutes time frame works well, but it's working starting 2018 up to 2022 so far. I don't know how long this is going to still work. I mean, you could still try it this year, and then after a couple of months, this strategy might stop working. But for the moment, it's working well, especially for the last 2 or 3 years. And then I thought maybe since this strategy was built for a 1 minute candlesticks, for 1 minute time frame, maybe I'm running it for the 15 minutes time frame and it's not supposed to be working on that time frame. So let's try it on the 1 minute candlesticks. And in this case, I'm not going to go through the details. It's exactly the same code as before, but we have a technical challenge for this particular time frame. Because of the high number of the candles, you have a high number of rows. So if I'm printing the tail here, we can see that we have a huge number that maybe our machine or our program is not going to be able to run through as smoothly as before. So we have 1,578,359 rows. One of the solutions is simply to slice parts of this data frame. Test your strategy on, let's say, from 0 up to 30,000 minutes candles. So in this case, probably a month or something very similar to a month. And then if you have something positive, something winning strategy, you can run it on a different slice of your data frame on a different 30,000 candles. So now let's go to the results and check what it gave. Now we have the signals. It's working well, just as we needed. And again, for the RSI, in this case, I put 3, but you might as well put 2 and try it on your own. However, for the results, we can see that we have something that is around 6.8% for the first fixed distance 45 pips stop loss and take profit. Now, this might be changed in this case because we changed the time frame. However, I really changed it quite a lot and I didn't find any winning combination. 45 seems to be the sweet spot for this part. Maybe you will find something different. If you are curious enough, you can run the Jupyter Notebook file and experiment on your own and leave a comment. Let us know if you find something interesting. The win rate is around 54%, which is not bad. It's a good win rate. And the maximum drawdown is around minus 12%. So it's also something that is not very bad. But the equity plot, if we look at it, we have some wins at the first third of the month, let's say, and then we have a drawdown, we have a loss, and it's not as spectacular as we would like it to be. So it's in 1 month. Now, if I take a different month, it might be a losing trade, in this case, a losing strategy. The other stop loss and take profit method is to use the ATR related and the take profit stop loss ratio. And this one gave minus 1.2% in return. So it's a losing, it was a loss during this particular month. And the third one, where we are using the trailing stop loss distance, we have minus 3% of return. So it's also losing 3% regarding the starting part of the equity. Okay, so it's not as spectacular. We would have expected something better. Still, I'm going to put this file in the link in the description below. You can also download it. It's for the 1 minute time frame. You can experiment on it, check it out for the different months. I'm not going to spend more time on this. The third time frame I was curious about was the 1 hour chart. Okay, so the 15 minutes was working more or less well. The 1 minute was a bit more difficult to control. However, if we go up in the time frame, usually things tend to be easier from the algorithmic point of view. So the 1 hour chart should be something easier to manage. And we loaded the data, we checked the signals, and it's exactly the same program as before, only we are using different parameters that would fit the current time frame. I'm using the RSI here equal to 4. It's the RSI length. And then we are going to check the results. Minus 20% in return for the first strategy, where we have a fixed distance of stop loss and take profit values. Now again, when you change the time frame, you might want to modify these distances accordingly. So instead of 45 pips like we have used before, I'm going to use 100 pips in this case, because we are at a higher time frames. And this is the equity plot. We can see that we had a small rise at first, but then it was decreasing. So over 3 years of data, we couldn't manage to have a winning period except for this start here. Then we have the ATR related stop loss and take profit distances, where we have also a loss minus 6%, a win trade of 44%, very low for this strategy. And this is the equity plot. Okay, so now we can go again and check the third strategy with a trailing stop loss, which is minus 3.4. Now, remember that these values and these results are highly dependent on the RSI length that we are considering at first. So instead of RSI equal to 4, I'm going to take it back to 3, like we have used in the previous time frames. And just to be complete regarding this video, I'm going to run this back again and we will check the results together. So we have a return of minus 86%. This is a huge loss, and this is our equity. It had some small ups, nothing to be mentioned, but the whole trend is going down. So this is definitely a losing trade, a losing system in this case. For the ATR related management, we have a return of 14%. And if we look down, we have something more acceptable, but still it's not really a trading system. This is not a trading system where you would want to put your money in. And the third way of dealing with stop loss is the trailing stop loss, providing minus 8.6% in return. And this is our equity curve, which is definitely a losing system. And the best result we could ever have is this beautiful curve. It's an uptrend equity, which is not affected by the market changes. It simply kept winning over 3 years period. Usually when I have something like this, I like to stretch the risk and see how much we could squeeze out of such a winning strategy. So I'm going to change the margin here and test if we are taking 1/100, and we are reaching something around 450% in returns over 3 years. So this is more worth it in this case. Now remember, more leverage meaning more risk, and don't forget that we are trading with 20% of our equity. Okay, sorry for the long video and the long analysis. That's all I had to tell you for this video. Don't forget to like and subscribe if you found the information helpful. If you have any other scalping related ideas and related to this particular system or different systems, don't hesitate to drop a comment. Until our next video, trade safe and see you next time.